Welcome to Boca, everyone. I really appreciate you all taking the time to join us this evening as we zero in on this small cap alternative financing revolution that is sweeping across our capital markets. I'm Dara Albright. I'm a proud co-producer of tonight's event, and I'd like to introduce you to my co-producers, Sally Outlaw and Andrew Rockmell. They are co-founders of Peerbackers. And they are true legends in the crowdfunding world. So, yeah. So in case you're all wondering why we've gathered here tonight, I put together a short little PowerPoint that kind of frames the event, introduces everyone, and really puts it all together. And my story begins 239 years ago, but I promise it's a short story. And it begins 239 years ago when a nation was founded on a simple idea. And that was that each of its citizens, no matter how rich or how poor, would be able to have the liberty to design their own destiny. And it was in this vein that people were given inalienable rights. And part of those rights were the right to invest and the right to invent. And it was this principle of giving citizens the freedom to invest in and profit from the ingenuity and invention of their fellow citizens is what transformed that young nation from a vast farmland into the greatest economic superpower in the history of the world. But between bubbles and crashes and scandals and crises, America, she lost her way. And laws were passed that really began chipping away at our economic freedoms. And as more rules piled on, it became next to impossible for small businesses and entrepreneurs, who are the lifeblood of the American economy, to access the capital that they needed to innovate, to hire, to further middle-class prosperity, and as well as upward mobility. And government overreach and all this red tape really has gotten so completely out of control to the point where Shakedown Street, I mean Wall Street, doesn't even embody free market capitalism anymore. You know, government has this remarkable ability of resolving a crisis by creating a new one. Case in point, what was their solution to the 2008 financial meltdown? 2,319 pages of legislation that permanently wove too big to fail into the fabric of our financial system. Dodd-Frank created an environment where the biggest financial institutions and corporations would be allowed to thrive at the expense of America's small businesses, our entrepreneurs, and our retail investors. The regulatory burdens of Dodd-Frank nearly destroyed small business lending. In fact, a number of small banks collapsed, and sadly, these were the very small banks that America's small businesses relied on for their loans. And our equity markets are even more flawed than our credit markets. They disproportionately favor large caps, a few large investment banks, and the largest of our institutional investors. This comparison chart right here really says it all. This is a comparison of Intel's IPO that went public in 1971 versus Alibaba's IPO in 2014. In 1971, Intel goes public with a prospectus that totaled 38 pages. There wasn't even a section in that prospectus for risk factors. It didn't even exist at that time. Intel went public at a $58 million valuation. It raised a little less than $8 million on its IPO, and those investors who bought Intel on its IPO debut and held it, they held it to today, realized a return of over 280,000%. Staggering. Now, 43 years later, a company called Alibaba goes public. Alibaba goes public with a 325-page prospectus. 39 pages alone is just of risk factors. They raised $25 billion on their IPO at a $170 billion valuation. Now, think about this. In order for Alibaba's IPO investors to realize the same return as Intel's IPO investors, Alibaba is going to need to be trading at a $480 trillion market capitalization, which is 6 times more than the GDP of every nation on this planet combined. That is outrageous. It is outrageous that today's retail investor should have to wait till a company is billions of dollars in market capitalization before it has any opportunity to invest. Where is the economic justice in forcing retail investors to serve as the exit strategy for our financially privileged? There's none. But thankfully, crowd finance is righting this wrong. Through regulatory easing and technological achievement, crowd finance is transforming both our equity as well as our credit markets. It's democratizing the flow of capital, and it's bringing funding back to small businesses as well as yield and growth back to our smaller investors. But most importantly, it's returning America back to her roots, to the founding principles that inspired generations of American innovation and economic prosperity. And in just a few short years, the crowd finance industry has already built a vibrant ecosystem of new players, as you're going to see in these next two slides, and some of them you are going to meet here this evening. So here's a snapshot of the debt side of crowd finance. This landscape, as it's brilliantly titled, it depicts the lending players in the leading lending players in the online lending ecosystem. Now, this is an industry that has become nothing short of a worldwide phenomenon in just a few short years. Let me give you an idea of the staggering growth. This is an industry that started from zero in 2006. It exceeded $8 billion worldwide in 2013 and is on track to be a $40 billion industry in just the US and UK alone by 2016. Now, think about this. It took Prosper, which is the second largest P2P lending platform, 8 years to do $1 billion in loan originations, their first $1 billion in loan originations. It took them a mere 6 months to do its next $1 billion in loan originations. That's how fast this industry is growing. And Lending Club, the world's largest P2P player, recently went public. As many of you probably know, they raised over $1 billion in their IPO 2 months ago, and it was the second biggest IPO in 2014, exceeded only by Alibaba's $25 billion offering. OnDeck Capital, a online lending service for small businesses, further validated the success of the online lending model when it completed its $200 million IPO less than a week after Lending Club's. And both of the shares, both stocks soared in the initial aftermarket. And it really substantiated retail's appetite for marketplace lending. We're so honored to have with us tonight Daniel Gorfine. He's OnDeck's VP of External Affairs and Associate General Counsel. I've been a big fan of Daniel since his days at Milken Institute, and his leadership has really helped shape the direction of this industry. We also saw in 2014, venture capital continue to really pour into the space. Funding Circle, which is a global leader in online peer-to-business lending, raised $65 million in 2014 in a Series D. Their funding was led by Index Ventures with participation from Accel Partners, Union Square Ventures, and Ribbit Capital. We're really excited to have with us Kris Barney, Funding Circle's Strategic Finance Manager, with us tonight as well. Orchard Platform. It's a leading online lending analytics provider and a creator of this awesome landscape chart. They recently raised $12 million in a Series A. Their impressive cap table now includes John Mack, who is the former chairman and CEO of Morgan Stanley, Tom Glosser, former CEO of Thomson Reuters, and Vikram Pandit, former CEO of Citigroup. And we're pleased to have here with us tonight Matt Burton, Orchard's CEO. We also have with us tonight Brian Korn, partner at Capital Markets Group at Manatt, Phelps, and Phillips, and he's a recognized attorney in the P2P and crowd finance space. He represents a number of platforms listed here and in the marketplace. So why is smart money chasing online lending, you ask? Well, as Jason Jones, an institutional investor in the space, will tell you tonight, it's due to the fatter yields that in many instances return more to investors in 1 month than typical fixed income asset classes do in an entire year. Jason actually has been one of my key speakers since I first started doing these events 4 years ago. He's a co-founder of Lend Academy Investments, and as I usually tell people, you'd be hard-pressed to find anyone on the planet more knowledgeable about P2P investing than Jason and the Lend Academy team. Now, whether you are an issuer, a banker, or an investor, Daniel, Kris, Matt, Brian, and Jason, they're all going to show you how to profit in this escalating industry. Now, I loved Orchard's landscape so much that it inspired me to create what I call the equity sphere, which is a sister flowchart depicting the progression of the equity side of crowd finance. And what this does is illustrate a modern path of business capital formation that's driven by what I call investimers. Investimers are a new breed of retail investors that basically invest in the company that make the products that they consume. Now, some of you just know these investors simply as Peter Lynch disciples, because that's basically what they are. I mean, it's crowdfunding is the invest in what you know mentality. And as you could see, the equity side of crowd finance is also developing rapidly. And that is primarily due to what's known as the Jobs Act. With us today to discuss Reg A, which is Reg A and Reg A Plus, which is a key component of the Jobs Act, and how Reg A can actually work within this rising online financing paradigm, is Samuel Guzik. He's a partner of Guzik and Associates. He's an industry-renowned attorney, a securities attorney, most known for his thought leadership on Reg A. He's probably one of the most brilliant attorneys on the planet, and I say that not as a fan, but as a client. We have with us Gene Massey. He's the CEO of MediaShares. He's an SEC, MediaShares, which is an SEC-compliant patented technology that facilitates online securities offerings for fans, customers, and other types of affinity groups. I first met Gene coincidentally 4 years ago here in Boca Raton. Gene flew in to attend an event that I was hosting down here where some of you were at. In fact, Dave Wield was a speaker at that event, as was Jason Jones. We have with us tonight also Jim Riggs, who's the head of investment banking at Maloney Securities, which is a national investment banking firm that really has been on the forefront of raising capital and creating an aftermarket for Reg A financing structures. And Jim is actually here with his client, Steve Sadler, who's the CEO of Allegiancy, which is a commercial real estate asset manager that in 2014 completed a successful $5 million Reg A offering that was underwritten by Maloney. So I'm really excited to kind of hear about that story and that experience. Okay. Now, my story ends with a quote from Dave Wield, tonight's keynote speaker, and this is something that Dave said at my Reg A event that I did a couple of months ago in New York City. And when Dave said this, it moved me then, it still moves me today. And just to give you some context, Dave was talking about Intel, and it was this embryonic microcap company that couldn't even deliver its first product on time. And it not only did it inspire a whole generation of iconic brands, but it birthed entire industries, including semiconductors, computers, wireless, and genomics. And, you know, Dave basically said, you know what, since no one is smart enough to predict the ripple effects of game-changing technologies, it's important that we have a capital market system that provides opportunity for a wide range of businesses, because only by having lots of balls in the air, and I think he was actually juggling when he said that, only by having lots of balls in the air will we increase our odds of capitalizing that one company that may very well save mankind. And I think that this statement really highlights what is at stake here and why we need events like this to keep moving this industry forward. So I'm just going to end by thanking our sponsors, whose generosity always makes these events possible, and we really always appreciate the support. And here's tonight's impressive lineup, and we're going to kick it off right now with our online lending panel.
Great. All right, well, thank you very much. And first and foremost, I want to thank Dara, Sally, and Andrew, not just for inviting us to be on this panel, but for getting us out of the cold and snow in Washington, D.C. and New York this morning. So thank you for that. So my name is Daniel Gorfine. I'm the Vice President of External Affairs at OnDeck. As Dara mentioned, OnDeck is a financial technology company that's relying on credit and technology innovation to transform small business lending. To date, we've provided over $2 billion in loans to small businesses. And also, as Dara mentioned, in December of last year, we went public on the New York Stock Exchange. We serve true Main Street businesses. The median age of a small business borrower is 7.5 years, and the median revenue is greater than $500,000. We're predominantly an on-balance sheet lender, though in the last quarter, 18% of our loans were sold to institutional investors through our online marketplace, or through the OnDeck marketplace. Also last year, we executed the first investment-grade non-SBA small business loan securitization sale. So I recently joined OnDeck from the Milken Institute think tank, and I'd like to believe that I was the missing link to our going public. But with those delusions of grandeur aside, my policy work at the Milken Institute similarly focused on expanding access to capital and thinking about how financial technology is changing or transforming markets and services. At the same time as we have all been tracking developments in the world of crowdfunding and crowd investing, there has been tremendous growth on the credit side as new internet-based models of consumer and small business lending have developed. Today's panel will focus primarily on online small business lending and explore the development of marketplaces in this space whereby individuals and institutions are able to invest in a new asset class, oftentimes assisted by innovative technology intermediaries. The development of the marketplace lending, I would argue, is largely driven by two key factors. In terms of for small businesses, they've demonstrated an increased interest in efficiently securing capital through online lenders who are able to provide loans where banks will not, or with significantly less friction. As I mentioned before, online lenders, including OnDeck and Funding Circle, are now providing more than $1 billion to small businesses annually. This is ensuring a significant volume of loans that may be available for purchase. At the same time, retail and institutional investors have become increasingly interested in this new emerging asset class and can purchase whole or fractionalized loans originated by online lenders. This asset class can provide access to a great cross-section of American small business. As we will discuss today with our panelists, there are a number of different marketplace models and practical considerations for all participants in the marketplace, and obviously also very important to understand distinctions. So with that, maybe we'll just run down the line. I'll have all of our other panelists introduce themselves, and then we'll dive into hopefully exploring some interesting topics. So we'll start with you, Jason.
Okay. My name's Jason Jones. I'm the co-founder and a partner at Lend Academy Investments. By way of background, I'm a former venture capitalist and investor in internet companies. And I've spoken at many of Dara's conferences in the past. My attraction to this space has always come from the idea of kind of the eBay for financial services. And I was looking at just online technology that could connect buyers and sellers. Did some work in the secondary shares space where people who worked at private companies who have generated a lot of wealth, the Ubers and the Airbnbs of the world, that are not public, but are very valuable. I started there and said, okay, this is a fragmented market where technology can connect people who want to sell their shares with people who'd want to buy private shares. So I started looking at that. Then I shifted and looked at the crowdfunding space, which was enabled by the Jobs Act, which was more startup-oriented companies that wanted to raise equity to start their businesses. This is kind of the angel list kind of crowd. And then I shifted my focus and looked at a third area, which was credit, peer-to-peer lending, where lenders matched with borrowers. And after I stepped back and I looked at those three categories, I personally made the decision to focus my attention on the credit market, which I found as a huge market that was completely inefficient. And there's two structural issues that I found really interesting and inefficient. One is that consumers are paying 20% to their credit cards, and the credit cards are owned by the banks, which have a monopoly. And there's an ability to refinance those consumers at a lower rate. And the other structural issue is that small businesses can't get access to capital. The banks just don't lend to small businesses. You can't get a $50,000 loan from a bank. They say, go use your credit card. It seems ridiculous for a small business owner. So that feature, that structural issue in the market is solved on the small business side. So those are the two areas that I found interesting. Sorry for going on. Probably shouldn't have said so much at the beginning.
That's great. Please, Matt.
My name is Matt Burton. I'm the CEO and co-founder of Orchard. I actually come at this from an interesting angle as well. I spent my entire career building out large-scale exchanges, and previously was in the advertising technology space, and we built up one of the world's largest exchanges, and then that company was sold to Google in 2011. And I found Lending Club actually during a Department of Justice antitrust review of that acquisition, which I would wish upon no one if anyone's had to go through that. But I found Lending Club and I was amazed because it literally looked identical to some of the early work that was done. And the amount of disruption that had happened in the media and advertising space over the past 10 years was just enormous. And Lending Club was my peak to see that it was about to happen to the credit space. And so I've been following it as an investor. You know, we build out technology that connects institutional investors and originators. And you know, I think we're just at the very beginning. This space is not only growing exponentially, but it's accelerating as it picks up steam, which is very rare to find spaces like that.
So as Dara said, I'm Kris, Barney, and I'm the Strategic Finance Manager at Funding Circle. Funding Circle is a global marketplace lending platform. We're headquartered in the UK with a really robust US operation as well. Life to date, we've lent more than $850 million to small businesses. And as a global company, we really position ourselves as connecting high-quality, credit-worthy small businesses with investors that are looking to lend. Our specific product is a bank loan replacement or bank loan alternative type of product. In the US specifically, we have straight line, fully amortizing, monthly pay term loans with 1 to 5 years in term. Interest rates that range from 6% to 21%, and across 4 different risk bands, A+, A, B, and C. We raised $25,000 to $500,000 for those loans. And on the investor side, all of those loans are senior secured loans with both a UCC filing as well as a personal guarantee.
Hi, everybody. I'm Brian Korn. I'm a partner in the capital markets group at Manatt, Phelps, and Phillips in New York. I got into the peer-to-peer space looking at the Jobs Act, which stands for the Jumpstart Our Business Startups Act from 2012, which really revolutionized the finance world in several significant ways. One we know of is the IPO on-ramp or IPO reform, the ability to go public at a lower cost, confidential filings, test the waters meetings. But the other aspects of the Jobs Act were equally transformative, something called Title II, which is now the ability to take a private placement, which was previously a transaction among people who had contacts and knew each other beforehand, and advertise that transaction. So you had a public offering and private placement dichotomy. Post-Jobs Act, you can now take a private placement and advertise it, and that has really fueled a lot of the crowdfunding and peer-to-peer space. People often talk about crowdfunding as Title III, which is the ability to go to the public without an SEC registration. We have had rules out for 2 years ready for comment, and the SEC has not taken action to finalize those rules. And then the next panel is going to talk about Title IV, which is the small offering exemption, Reg A+. Peer-to-peer is really a fascinating technology displacement of traditional banks. People come to me sometimes and ask, do the banks know about this? What do they think? And the answer is yes, of course. In the beginning, I think they were a little bit too small to worry about, and then the industry took the very smart decision of number one, collaborating with regulators. So the industry talks to the Fed, they talk to the OCC, they talk to the Treasury Department on a regular basis. So this is not going on behind closed doors, and we don't any longer have sort of a run and hide approach. Underwriting criteria are set and collaborated with federal regulators and state regulators. And then the other issue is that banks really partner. All of these funds have to be sitting in a real bank somewhere. Most of the Prosper Lending Club funds are in a Wells Fargo account. Banks are underwriting IPOs for companies like OnDeck. So there's quite a bit of partnering, notwithstanding the relationship here, which would be a borrower borrows to refinance credit card debt of a bank. So I represent platforms, investors, and service providers. Platforms, just to give you an idea, kind of fall into 3 main verticals: consumer, which includes specialty consumers, so platforms that do auto finance, wedding loans, home refinance, home repair. Then we have the real estate vertical, which is mostly development loans and fix and flip developers. And then finally, small business, which is many people see the fastest growing sector, loans to smaller businesses, generally in the sub 5 million category.
All right, great. So I want to ask a set of questions to give everyone a better context and overview of marketplace lending. So as a few of you alluded to, the original concept of the marketplace was really popularized by Lending Club and Prosper, largely in the consumer lending space. Their focus initially was truly peer-to-peer or very retail-facing, and over time we've seen larger interest from institutional investors and accredited investors. So Brian, coming back to you, can you take us through the evolution of the marketplace model and give folks, without getting too into the weeds, a little bit of an overview of the legal landscape around it?
Okay, sure. So, and obviously people in the room have different degrees of experience with securities law, so I'll try and be useful to everyone here. Before 2012, there were generally two types of transactions in the U.S., the registered offering and the private placement. Registered offerings include IPOs, as well as the ordinary course NASDAQ, NYSE trading that you see on public company stocks. These are companies that have filed reports with the SEC. All the shares that are traded are listed through some registration statement that's been vetted and approved by the SEC, and they are ongoing public companies. Private placements are generally the realm of private investment funds, hedge funds, and other smaller pre-IPO companies that raise money by going to individuals and institutions that they have a pre-existing relationship with, or they qualify through an exemption. The most common two exemptions are Rule 144A, which allows you to raise an unlimited amount of money from qualified institutional buyers, sometimes called QIBs, who are generally persons with $100 million. And then the other more common exemption for this purpose is Reg D, which is the safe harbor for the private placement rules that allows you to raise an unlimited amount of money from accredited investors. Accredited investor is somebody who has $200,000 of income or $300,000 as a married couple, or $1 million of net worth, excluding the value of your primary residence. The peer-to-peer world is fundamentally focused in three directions from a regulatory standpoint. Number one is you have the Lending Club and Prosper, who are registered issuers, who have filed SEC Form S1, who keep the forms updated, file 10Ks and 8Ks, and regular periodic public reports, just like PepsiCo does, and all the other public companies. And they are selling payment-dependent notes through a registered platform. These are registered securities. You're purchasing a note that has an underlying relationship loan to it, and as a payment is made on the underlying loan, the funds from that payment minus a servicing fee are then sent to the holders of payment-dependent notes. The beauty of this is that you can have a $20,000 loan, and you as an investor might own $50 of it, $500, $1,000 of that loan, and you can customize how big or small an investment you want in that loan. That is the original peer-to-peer structure, and is now approximately, Matt can correct me, approximately 25% of that market still is in this payment peer-to-peer marketplace. People are buying payment-dependent notes. The second phase, which is where you see a lot of the high-volume consumer origination, and the reason they can originate in such high numbers and have an efficient marketplace is because about 3/4 of the loans that the larger consumer platforms are originating are being sold as whole loans to institutional investors. Investors sign agreements that say we're going to buy X amount per month or at least X amount per month. It also goes for some of the larger small business platforms, including OnDeck and Funding Circle. And I have clients who have signed purchase agreements to buy a certain amount of paper that is not a securities transaction, is a purchase of a loan, and as such does not go through the SEC registration process. It's much less expensive for the company, the originating platform, because they don't have to pay the SEC fee. They don't have to file a prospectus on that paper, and essentially everything gets transferred and custodied with the investor. The third is what I call everybody else. So if you're not selling whole loans, and you're not selling payment-dependent notes to a registered platform, most likely what you are doing in this space is you're attracting investors to your website to buy peer-to-peer payment-dependent notes through accredited investor channels. So you're an accredited investor, you qualify under the Reg D exemption, which I mentioned. You can sign up for a patch of land or Realty Mogul or any of the other sites, buy payment-dependent notes off of a specific loan, and as a federal exemption, Regulation D, that transaction is able to be done in all 50 states. Whereas, interestingly enough, Lending Club Prosper, the payment-dependent notes that are sold through the registered channels, because they're not listed on a national exchange, they have to go state to state and ask for permission to register and sell these notes. And so even Lending Club and Prosper can't sell in 25 to 30 states, depending on the platform. So that's kind of the basic mechanic. Registered notes, Reg D, nationalized private placements, and whole loan sales.
And so we'll have a test on this at the end of the panel. But thanks, Brian. So Matt, let me turn to you. From your perspective and that of Orchard, tell us a little bit about the evolution of institutional investor interest in this space, whether it's small business or consumer.
Yeah, so not surprisingly, the first institutional investors in the space were specialty hedge funds that were basically passing around the hat to raise money to then invest in these loans. And they were using advanced risk models to be able to, create alpha from the basic standard indexes of returns you were seeing off the platform. So that started in kind of the end of 2012. Since then, we've kind of seen it grow to, first kind of went to family offices, then it went to BDCs. Now we're seeing people work on closed-end funds, endowments, pensions, life insurance. Pretty much the spectrum of institutional investors are now taking a harder look at this today. In terms of the volumes, capital velocity is something that we track very closely. So when we first launched our platform, basically, we started with the back office solution for the operations, accounting teams, as well as the fund admins and custodians. But then last January in 2014, we launched the order routing system, and we placed $2 million worth of orders for institutional investors, and popped open the champagne, and we're super excited and had no idea what was about to come hit us, because as the industry kind of exploded, we're now, I looked at the numbers today, and we've already done over $4 million in loan purchases today, and so you can just see how that continues to accelerate as the larger institutionals start to move in and take larger and larger chunks. It used to be, if you had an institution buying $5 million a month, that was large. Now there are some platforms like Manatt who won't even sign up an institutional investor unless they plan on deploying at least $100 million this year.
Great. All right, well, so Jason, we've been talking a lot about institutional investors now. You work a lot with individual investors. How do you help them keep up? What is it that you do to get them involved in marketplace lending?
Sure. Okay, so like Matt said, back in early 2013, there was a shift that took place in the marketplace. Before early 2013, both Prosper and Lending Club were 100% retail. They were individual investors who would go onto the websites. Like I said earlier, it was like eBay. You'd go onto the websites, you'd see a bunch of loans listed on that website. You'd kind of scroll through them. There'd be a bunch of variables that you could research. They'd sit up there for about 14 days, and you could buy small increments, $25 increments. And you'd put your order in, and hopefully others would put the order in for the same loan, and eventually the entire loan would be filled, and it would go live, and you would actually make an investment into the loan. That's how it was historically done. Starting in early 2013, the institutions came into the marketplace. They started buying whole loans. Instead of just buying a fraction of loan, they bought the whole loans. And they came in droves. And it's been a great business for Orchard, who's kind of enabling that business. And they basically discovered the space. The space had about 5 years of history at that point, so there was a track record in place. And the yields were really amazing, 10% yields on short duration notes. So kind of what retail had figured out early, institutions realized, hey, this is a great space. I'm kind of refinancing the credit card space, which is a huge market. and generating nice yield along the way. So if you fast forward to today, the Prosper Marketplace is approximately 96% institutional. The Lending Club Marketplace it's debatable, what percentage is actually institutional. I would guess it's probably in the 80% range, but if you look at their numbers, they seem to report lower numbers than that on institutions.
Well, they also let institutions buy fractional, which makes it very difficult for you to figure out what their numbers are on both sides of that.
Yeah, but the bottom line is that institutions have dominated the platforms over the past few years, and my business has always kind of been in the educational space, kind of educating individual investors on how to buy peer-to-peer loans. And we've developed a strategy for wealth managers and individual investors on how to keep up with the big guys. And there's basically two factors that you need to keep up with the big guys. Number one, you need speed. Loans are now uploaded, whereas beforehand loans would sit on that platform for 14 days. Now they're uploaded four times a day, 1,000 loans per upload, and they're bought in fractions of a second. The big order management systems make calls to the websites 20 times per second and are buying loans at that frequency. So for the little guy who's kind of wants to look at loans and do a little research, all the good loans are gone by the time you actually get to pick one. So you need technology that can actually rapidly ingest all the loans that are uploaded and then purchase them.
That's a huge change, right? It used to be 14 days. Your loan didn't get funded. They called you and said, sorry.
Yeah.
You had to write a personal statement of what you were going to do with the money. That's all done, right?
That's gone. That's gone. Now it's fractions of a second.
All right, thank you.
Hold on. The second part is you need credit. You need to be able, there's 500 variables per loan. You need to ingest all 500 variables on every single loan and determine which ones are actually valuable to buy and which ones you should kind of ignore. So that's the second part. So those are the two kind of products that we offer to our clients, give them a solution so that they can compete with the institutional investors.
Great, thanks. And Kris, Funding Circle has a very interesting story with respect to the marketplace. Can you tell us a little bit about the evolution of the model originally in the UK, and then how that experience has differed from the activities here in the United States for Funding Circle?
Yeah, absolutely. So the history of the UK probably has a lot of echoes of how the overall marketplace lending landscape has evolved in the US. We were founded in 2010, and when we were founded, it was really connecting a credit-worthy small business with a retail investor who was looking to buy in fractional increments. Similar to the industry, we operated and scaled very well under that model for a long point in time, but somewhere about 18 to 24 months ago, we started also expanding our investor base into institutional investors. At this point in time, over in the UK, our investor mix is about 50% retail and 50% institutional. And it's also worthwhile to note that on the institutional side, the UK government is actually one of our largest investors in the UK. Switching that over into the US, our antecedent, which is now Funding Circle US, was originally started as the Endurance Lending Network in 2012. It was acquired in late 2013 and became Funding Circle US. And because of different regulatory requirements in the approach of the market, Funding Circle US actually focuses on institutional investors and accredited investors. We don't actually have a retail platform. As an overall mix as we go forward, we think that, somewhere in the UK, it probably evolves to maybe a 70-30 institutional to retail mix. In the US, we're about at a 70% institutional, 30% accredited investor mix, and that feels roughly like a pretty good balancing point for us. And to some of the other points that were noted before, we also really do care about and want to serve all of the different channels of capital. We do have for the institutional investors whole loans, and then we also use borrower payment dependent notes that are as securities for our accredited investors. And to Jason's speed standpoint, something we've also built in the United States is a program called Auto Invest. It's not new. Prosper and Lending Club and others have it. But we use a slightly different approach to it, to where on our fractional marketplace, which is where practically all of our accredited investors participate, we reserve a portion of every fractional loan. And any investor that signs up within our auto bid program, if that loan meets the basic criteria of term or risk band that they've specified, they're guaranteed to get an allocation into that loan. And so we also do support the pick and choose model where technology solutions and speed are very important. But for investors that are looking to get exposure to this asset class and have a bit more of a passive experience and don't want to be rapidly auto bid out of things, we have that reserve channel that auto allocates in for those investors so that they're on even par without having to have very sophisticated technical solutions in order to participate.
Thanks, Kris. And actually, that leads into kind of the next topic I want to hit, which is the details of this particular asset class. And as you're getting a sense, there's a lot of differences between the different types of products that are offered through lender platforms. So for example, with the OnDeck marketplace, it is solely for whole loans that are being made available only to institutional investors. The loans are graded based on their OnDeck score, which evaluates a business through 2,000 different data points and then provides a grading that allows an investor to make an appropriate risk-return determination. So then the loans with those defined attributes are then randomly assigned to marketplace participants. So it's obviously important to understand which platforms are available to institutional only, having a retail face as well as an accredited investor face. So with that, let me actually go to Jason and Matt. I mean, both of you, I'd love to hear your thoughts. What is the standard, or if there is a standard range of characteristics that investors are looking for when they invest in or purchase these loans? I mean, and relatedly, what kinds of returns do you typically see?
I guess I'll start out by just talking about there's lots of different platforms, and finding the right platform for you is not an easy thing to do today. We're tracking 450 different platforms. Currently, we have an originator database that is accessible to our clients for free that has 55 originators in it, OnDeck being one of them, that has all of the basic characteristics of the loans, how much is being originated, what are the yield profiles, what's the minimum check size, all the information you need to make a decision. And we actually created that in order to help investors find the platforms that make the most sense for them. In terms of the yields, it really depends on what type of investor you are. So if you're looking at the hedge funds, they're going after the riskier sections of the credit spectrum. The BDCs are also in a similar place. Both groups are mainly using leverage. As you move into kind of family offices, they're looking for more of the conservative, low volatility returns. And as you kind of get into larger and larger institutions, it kind of varies on their strategy. But I would say that, the conversations we've had with like life insurance companies, they're looking for an extremely low volatility product that basically they're viewing it as an alternative to securitization, where they have control to build their own pool, securitize it, sell off the equity piece, and be able to create a perfect match on their liability side.
Yeah, I would say from our perspective, there's some people that view this as an alternative to cash. They have their money in a money market mutual fund, and it's making nothing. It's making 1% or less, and they're looking for just a slightly more yield. They're willing to take slightly more risk, but they're really looking to invest in a really conservative product that can yield them, 4%. That's one category that we deal with. The other category are the people who are taking money out of their investment account that are looking for yield and are looking for kind of a constant kind of monthly check. And those people are typically, we have products that range from 7% up to 10% net yields to investors.
Okay, great. And Kris, I mean, you've started to get into this, but in more detail, what are the different ways that investors can become involved with Funding Circle?
Yeah, absolutely. I'll speak specific to the U.S. market, but for institutional investors, again, approximately 70% of our capital base comes from the institutional side. We primarily service that market with whole loans, and we service that in kind of two different ways. We have a whole loan marketplace where we list specific information about a loan, including historical financial information, loan specifics, years in business, industry, et cetera. Investors can review those specifics and then based on those decide whether or not they want to try to buy that specific loan. So that's one way in which institutional investors can participate. The second is for select institutional investors. We have something we refer to as forward flow, to where they've diligenced us as a company, they believe in our underwriting, and they sign up to get a randomly allocated portion of our overall loan volume, call it roughly 5% or somewhere in that range. So that's primarily how larger size institutions that are looking to allocate $5 million or more more of capital to Funding Circle tend to participate. And then on our fractional marketplace side, we service accredited investors who want to participate directly, accredited investors that are advised by wealth managers, family offices, and other institutions that are either looking to build a much more diversified portfolio than they might be able to get with $5 million on the whole loan marketplace, or that are looking to allocate less than $5 million. And within that marketplace, we also have a limited partnership fund for investors that truly want more of a passive, buy the index of Funding Circle loans type of approach. And so each of those has various benefits and trade-offs. It depends on how the institutional investor wants to participate. Basically whether or not you want to be active versus passive, and how much capital you're looking to invest into the channel, really try to determine which of those particular ways of participating makes the most sense for an investor on our platform.
Great, thanks. All right, Brian, I'm going to start with this question, and I'll direct it to you, but then open it up to everyone. So thinking a little bit about investor considerations and potential risks, and how those risks may be mitigated. So what do you think about in terms of risk? Is it interest rate risk? Is it credit risk? Is it regulatory risk? And how do you advise mitigating those?
I mean, I think all three of those types of risks are present in this platform. Regulatory risk is something I get asked about a lot. We have a very fragmented regulatory system. It's state, it's federal, it's securities, banking, funds, and fortunately or unfortunately, there is no Department of Peer-to-Peer Lending in Washington. So you have the banks looking at whether the bank lending aspect is done correctly. The SEC is looking at, are these securities being sold in a way that's compliant? Whole loan sales are largely unregulated. It's effectively an asset purchase. I think that you really have to have a mind to the different risks involved from that side, although I will say that we seem to be in a very static environment with respect to the regulation. You don't have the large target on everyone's back like the payday lenders have, or people who are lending to the military or to widows and orphans. Most peer-to-peer transactions are not somebody's last mortgage check. You have a willing borrower, a willing investor. Rates are more or less disclosed. Defaults are within the range of disclosure. And so, one thing that you've learned, and I've learned from working in banks, is that if you don't have a lot of people complaining about an industry, there will be a lot less heat on it from a regulatory aspect. The other thing is these industries are really taking the existing rules. They're using a technology solution with respect to a lot of what's going on, but there's nothing new or novel about the approach here. Lending and borrowing has been done for centuries, and you just simply have the ability to do it in a much faster way, mobile and online. Same with investing. It's not traditional investments. You can't buy these loans through your Schwab account or at Merrill Lynch. You don't have a CUSIP number. There's no standardization with respect to these securities. So it is an alternative vehicle, an alternative finance product, which makes some people uncomfortable. You can't margin against it. But those are things that you should consider. And then obviously the macro environment is very important. A lot of people are looking at what's going to happen when interest rates go up, when borrower defaults tick up, when you have uncertainty in the economy. And what people like Matt and the organizations around the space that add value try to do is you'll see loans on the platforms, and some loans are better credit than others, even if they have the same score. There may be issues with the aerospace industry. There may be issues with borrowers from Phoenix. There may be issues with people who have only been in their job for 6 months. All of these aspects go into these grand calculations and help investors decide among a lot of loans that look alike which ones might be better and which ones might not be. And these get adjusted daily based on unemployment figures, housing starts, and the whole macro environment. So I wouldn't expect the safe return of treasuries, as Jason was alluding to, the sort of the person who's looking for a little bit more risk. It is a new product. It is something that most people have not dealt with before, but on the other hand, there's people making real money in the space. There is real sunshine on the on the industry. So this is not something where, the cops are going to come and everyone's going to clear out of the room. It is something that's out front. I think the IPOs generally also help the industry as sort of a coming of age exposure test, and you're going to see more and more of this.
Thanks. Other thoughts?
Yeah, I'd note that interest rate risk and regulatory risk are certainly two that we hear a lot. I spend the majority of my time on the phone with investors, both the credit investors, wealth managers, and institutional. And at least from our standpoint, I think the two items that the one factor that comes up a lot is investors will typically say, well, this industry hasn't been around for X number of years, so what happens through the next economic cycle? And then the other one that investors spend a lot of time with is underwriting, and specific to the asset class, how does your underwriting work, and is there enough historical data with your underwriting to feel that you've appropriately built your credit models? Touching on the underwriting one first, Funding Circle, if you look at the small business landscape, there is data out there, but there's not really super robust data sets that go back decades and decades. The SBA has some, the Federal Reserve has some third-party providers have some, but it doesn't go back as long as you'd want in order to be able to really closely and tightly proxy against how this asset class might look, or at least for the specific type of lending that we're focused on. And so how we think about that is we've been operating in the UK since 2010, so we've got pretty much 5 years of history there, and we're able to leverage a lot of that small business underwriting and learning from the UK over into the US to really think about how that informs our credit models. And in addition to that, every single loan that's analyzed, reviewed, and ultimately approved, if it is approved, in both the US and the UK, is reviewed by a seasoned small business underwriter. At the manager level, they have at least 5 years of career experience. Some go up to 20 plus years underwriting, reviewing, and analyzing small business loans at a community or regional bank. And so, it's really something that comes up a lot in our investor questions as really trying to understand what the core of your underwriting is and how you think about this, and are you pricing risk appropriately? And that's how we think about it as a company.
Okay, I would say we get the question, wait, you want me to lend my money to somebody I don't know over the internet on an unsecured basis? Like, why would I ever do that? Who is that guy? He's taking my money. And I think that's fundamentally that's a fear that everybody kind of has to start with, and a risk, obviously. But when you start to break it down, it really comes down to data, and the people we're lending to. We're getting credit bureau data on those people. We're getting 500 data points on those people. And we're not lending to one person. We're lending to thousands of people. So it becomes a numbers game. We know on average how many people pay back. We know what the average FICO scores are of the people we're lending to, which happen to be prime and super prime. So these are people who have established credit and have proven over their life that they're good credit. So I'd never want to lend to just one person, but when you lend to 1,000 people, you have a pretty good chance of, in aggregate, generating a decent return. There's going to be some defaults. There will be some people who do take that money, but on average, your net return will be really decent.
Matt, or should we open it? I want to leave time for Q&A. So if you have,
Q&A.
You ready for Q&A? All right. No risks.
Well, one thing I would say,
I like questions.
just on that, it is much more catastrophic for a small business platform to have a default than a consumer platform. There's a certain amount of default that is forecasted in based on the loan grade of consumer loans, but in the small business world, people assume if it gets through the Funding Circle or OnDeck process that it's almost bulletproof, and maybe they shouldn't think that, but that is something that I do worry about.
All right. So with that, let's open it up to some Q&A. Does anyone have questions? Yes, in the back.
From the business owner's perspective, the credit criteria, how does it compare to traditional banking criteria of the past? Because when I hear 2,000 data points, if I make an application as a small business owner, and it goes through your technology of 2,000 characteristics, how does that compare?
Yeah, I'll speak briefly, and then I'll also turn it over to Kris. But it's a very different process. The traditional bank underwriting process does look, especially for very small Main Street businesses, a lot at the personal credit history of the small business owner. that might be a factor within what the OnDeck score would look at, but there's a broad set of data points, including the health of the business itself, that we would rely on with the OnDeck score and with the underwriting algorithm. So it is a very different process. Kris, do you want to jump in on that as well?
Yeah, happy to touch on that from our side quickly. So we have every loan application with us starts with an online application, and at a minimum, borrowers need to have $150,000 a year in revenue, minimum of 2 years operations in business, and at least one of those last 2 years must have been profitable. Again, that's a minimum overall for our book. Average years of operations is 10 plus. Average revenue is over $2 million. But in a variety of ways from the borrower experience that we try to differentiate ourselves is if we think we're going to say no, we say no as quickly as possible. And so if you don't meet those criteria, you spent 30 seconds on our website and it said, look, you're not a core focus of what we're looking for. And then we have other associated boundary models so that as a person comes through the process, if it doesn't look like it's going to meet some of our minimum criteria or the scope of the business is outside an industry that we particularly lend to, we try to say that as quickly as possible to really appreciate and have respect for the borrower's time. And then if it does make its way, if it is a loan that is interesting to us, something else that's different from our perspective is the underwriter actually gets on the phone and talks with the borrower for upwards of an hour to ask specific questions about their business, to not just say this is the box that something has to fit into, and if it doesn't fit, it's out. We have this boundary model that filters out things that probably don't meet what we're looking for, and after that, we use the talented expertise of our underwriters to really dig into the company, understand the specifics of that company, and then ask that borrower, prospective borrower, specific questions to make sure we really understand the potential risk and reward so that we can make a really educated decision.
Yeah, and I would say I think it's that borrower experience that's so dramatically different under the models. The Fed has released a study 2 consecutive years showing that the average small business owner will spend 24 to 26 hours pursuing capital through traditional avenues, through traditional banks. And many times that's with uncertain outcomes. So in terms of respecting the actual small business owner and making sure that if it is a decline, it's when they find out early on, don't have to wait weeks or months and can go back to running a business. That's a critical aspect from the borrower experience. Gene, we'll go one there and then in the back.
The internet has allowed us to fractionalize financial participation in smaller increments. We've seen Kickstarter and Indiegogo and a lot of things like that fractionalize participation in tiny increments. Would it ever be possible in the case of video games and NASCAR teams or whatever, to fractionalize the investments, the loans, small enough so that you could have 1 million people say loan $50 a piece into something? Is that ever going to be a model?
I think the biggest issue right now and the reason that institutional investors are so focused on whole loans is because that is the only thing that they're able to get leverage on today. And because of the bankruptcy process is known for whole loans and has not been tested for fractional yet, until that actually goes through, we won't know if that's a possibility.
I would take the tack that we're in the sharing economy, and what you're talking about is the sharing economy. And I think that the trend is that way. I mean, I arrive here and I take an Uber ride to get here. It's in someone else's car who's sharing it with me. I stay at an Airbnb, someone else's home that's opening up to me, and I buy someone's loan who's letting me participate in their loan. This is happening on a massive trend across our country. And I think we'll get there someday, but it takes some time.
But you didn't fly someone's airplane. There are some platforms that sell very micro investments. So Fundrise, for example, is a real estate platform. You can invest $50 in a loan, or even less, I think $25. It's very tough when you get down to that level because it has to be meaningful where the investor cares enough about it. And if they put in $20, you're going to have thousands of people who have moved, who don't tell you where they've gone, and you just lose track of things. Plus, for smaller companies, you have the problem of the forced public rule. If you have 10 million in assets, which is a lot, I suppose, and 2,000 investors, you have to go public now under the new rules. So you don't want to blast out and waste a spot on somebody who's only going to put in $10.
All right, let me go to the back of the room, and then I'm looking at Dara. She's going to tell me when I'm when I'm out of time.
So again, a lot of this comes around, I think, from the interest rate bubble. Interest rates are so low, it's making opportunities in the platforms that you have, and you guys are way advanced. Ultimately, there's more and more platforms wanting to come in, bigger space, and then there's only so many borrowers eventually. And smaller platforms are going to have smaller borrowers. And what's your fear that at some point it's not like the brokerage industry, some smaller firm with smaller borrowers gets in trouble and somehow ruins it and ends up with 2,000 pages of laws regulating what you guys do?
Yeah, so the first thing is that the interest rate environment is fueling this, but I think a larger piece of it is Dodd-Frank. Because banks under Dodd-Frank are being penalized for lending in ways that they weren't before, where they're basically now just buying treasuries. I mean, the report came out, they own a record number of treasuries now, and it doesn't look like that's going to stop. So the banking industry that we know is being transitioned from lending to fee-based. And that is why we're seeing this group right here. And I think that if there is an interest rate change, these companies aren't going to die. But that second piece of your question around the fragmentation and if there's going to be risk, platforms will fail, right? That's going to happen. I've already seen platforms fail. A lot of them fail before they even get off the ground because origination is not an easy thing to do. There's lots of moving pieces on that side. But I think that overall, the flock is going to be really strong because we're seeing it go into every single asset class. Like what investors talk to me about, which is kind of not even really on the radar of most people, is the factoring space. There's like 5 big factoring companies that are moving into this space and people love that space. Are very high. And so, look, this opportunity didn't exist 6 weeks ago. And now it looks like we're going to have 5 different factoring companies start to enter it all at once. So it's a very fast-moving space. But yes, there will be companies that fail in the space on the origination side.
All right, I should probably take a question from David since he's our keynote speaker, so I'll get yelled at if I don't.
So some of these strategies are kind of cream skimming strategies. They're really kind of credit arbitrage. And then there's another group, I think the small business stuff when I was in Treasury. It was very clear that a lot of the infrastructure to lend to small businesses was obliterated in the wake of the credit crisis. So you're actually stepping into a void, a little of both, maybe a little mix of both. But on the cream skimming, how disruptive is that going to be to incumbent lenders? How much bacon is that going to steal? And how is that going to affect those businesses, those companies?
So Discover on their last earnings call mentioned that this is going on. So it's gotten to the point where they're mentioning it on their earnings call that people are going in and targeting borrowers that are kind of their cream of their portfolio and refinancing them out. So I think if that's happening and they're realizing it, it's definitely happening in a larger scale.
Because you look at the student loan space, for example, right? And I can't remember which company it is, but somebody came up with the observation that if you graduate from these institutions, you're money good and you're going to get a job, and if you graduate from all these other institutions, the default rates are going to be astronomical. So, now all of a sudden somebody's going to step in and cream skim, and then whoever's left holding the bag on the other stuff is going to have problems.
That's already happening. That's SoFi's entire business model.
I mean, when you think about it, it's not that much different than Amex giving gold cards and platinum cards and black cards to the people who are the wealthiest. I mean, it's the banks are losing money right now. The capital adequacy tests, the Basel III standards, Dodd-Frank regulations. It took them 5 years to come up with swap dealer reform, and even now there's only 6 people who understand it, and it's we're sitting around doing rulemaking thinking, well, meanwhile the house is on fire, but we have iterations of rules that carve out different niches. I think that you see bank after bank report earnings and are disappointing with respect to lending. I don't think that this is making that much of an impact because none of these borrowers are in their prime areas anyway. You're not going to waste risk-weighted assets on a small business or a consumer the way that you can with a large company where you have a much greater, what we used to call at Citi, a share of wallet, right? I can sell someone trading, investment banking, wealth management services. I'm much better off dealing with that person than where I only have a single product customer.
All right, thanks. I'm getting the sign from Dara, so we need to be done here. But I'm sure folks will be here to take questions afterwards. I'd like to collectively thank all the panelists for discussing these topics with us. Thank you.